Okay, so this is not only a plug for my book, but also just to explain how cool this system is for how it works. So this is the website on BVR's page if you're interested in looking at this book. I mentioned it in my newsletter this month. I also recommend the PDF version because this has been designed so you can copy and paste formulas from the PDF file directly into the Excel sheet you're building. So print is the one that comes up by default. I suggest you select the PDF if you're interested. Anyway, so basically, here's the Excel template, my version. I've got a little few other things that are not built into the one described in the book, but this is how it works. Here's a company that I'm spreading, the financial statements. I'm looking at data. The next tab over is where the BizMiner analysis would be. I'm showing you this is what it looks like pretty much before the data is input. This is where the data should go, all that fun stuff. Anyway, so looking at the spread, instead of you watching me type all the data, what should this be? This should be 552 and 959. Hit that. There, all of a sudden, all of my information is spread. Ta-da, there's all that information. So I can compare the subject to itself over time. That's what the common size analysis is for over in these columns. Click on the BizMiner ratio analysis. Oh, we need to put the data in, right? So BizMiner data 2 is a sheet where it's supposed to be at. Let me just show you this. I'm going to make a second sheet here. So this one, we're going to show that analysis, all that stuff there. And this one, 3 is where my data is saved. I'm just going to copy all of that as if I downloaded it from BizMiner. I'm going to paste it into place in the sheet that's looking at, and all of a sudden, these ratios for the industry average are all being calculated. So there's the formulas grabbing them. Again, the formulas grabbing the information from BizMiner in the template described by the book will be a little simpler than what I have here. But basically, that's what you're looking at, is the data from the company sheets are here, and then the industry averages from BizMiner are here. And the formulas are all pre-built in the template to explain how you calculate cost of sales to accounts payable is 97 by K86, because down below, there's accounts payable, and there's cost of sales. All this information down here is linked to the 5-year summary spreadsheet, where all that data is going to be input. And we're using the SUMIF function to grab all the data that we need. And we convert to common size stuff down here as well. So this is how it works. You download the BizMiner data, paste it into your BizMiner data sheet, come to your spreads over here, and all the stuff, these drop downs on this column and for column A are tied to the BizMiner labels. So it doesn't matter how many levels of gross fixed assets they have. You can just change drop-down menus. These are all drop-down menus to choose what they are. So if this were, for example, say inventory landed up here instead of 12, you could just change this to be inventory, and all the formulas thereafter on the ratio side and charts would be updated. So all I have to do is tell my template, this is where the information is. Like, this is the line the revenues are on. This is the line gross margin is on. This is the line interest expenses reported on. And it goes through and grabs it and calculates everything for me. So I can then have these charts. So these charts are all tied to a drop-down menu listing all the various ratios that one can look at. So I just changed the drop-down menu, and I've got a new chart. So that's how all of these charts were made. I just copied a sheet, changed the drop-down menu, then copy the sheet, change the drop-down menu. And you go through and you look at, here's this formula brings up the definition from the BizMiner sheet that you're going to build. So then you look at the ratios and say, okay, days payable. The definition says reflects the average number of days for each payable before payment is made. So the company is red. Looks like it takes them fewer days, to get each payment paid, each payable paid. That's a good thing. Net working capital business revenue. So just calculating the ratios is not enough. You have to also have to explain in your narrative what each ratio means. How is it going to justify the overall risk analysis that you're going to come up with for the specific company risk premium, or if you're going to use a multiple different than the average or the median, because the business is either super well overperforming, or maybe just well overperforming, or maybe just kind of overperforming as compared to industry averages. So you might change that multiple from average or median to maybe up by 20% or up by 40%, or especially when you look at the ranges of potential multiples available. There's always a max and a min, right? And somewhere in that range is where you're going to land for the subject business. It doesn't always have to be right in the middle. It can be somewhere within that range, right? So I'm explaining net working capital business revenue looks like, in this particular case, well, in 18, there was a negative number. But a high ratio indicates an overly conservative reliance on liquid assets, while low ratios suggest the opposite. So in this particular case, what do you think? Right? Is it good? Is it weak? Is it strong? Is it not? Explain that to the reader. Cost of sales to accounts payable. Measure of time, number of times payables turn over in the course of the year. High measures may indicate cash flow concerns. Well, do we have cash flow concerns with this particular company? You guys don't know because you've not completed the analysis. Let's go back and look at the financial statements. So in 18, we had losses, right? But overall, this company's been doing pretty good. We've got some other things they're bouncing around with. 21 was down year. But those are things the questions to wonder about and ask about. I keep going to look at the ratios. On top of ratios, in addition to those, I'll also do financial comparatives. I'll just look at reported cash balance as reported to industry average balances. And I'll do common size. So as a percentage of total assets. Dollar amounts, the company has had more cash in its accounts the last couple of years than the industry average. And it's a larger percentage of total assets than the industry average as well. Total current assets, the same kind of comparative. Well, they've got fewer current assets as a percentage of total assets than the industry average. Does that mean they're less liquid? Maybe. Their gross fixed assets, they have more equipment. Well, why? Well, these guys focus on building bridges and high traffic type things. And maybe they've got to have some stronger equipment than the average business. Net fixed assets, well, their stuff is highly depreciated. So in 2021, they've got some stuff that's matching close to industry average. So there might be time to be buying some more stuff. So these kind of charts and graphs illustrating the comparative of the subject company to industry averages is useful and quite helpful, and explain to the report reader where or why you landed where you did on your analysis of the risk of investing in the subject company. So it's just something. And just for fun, let's go here to reconciliation. It's going to be right here. Let's do the 60% one. So these are the way the methods worked out. So not a whole lot of goodwill in this particular one. Interesting, yeah? Anyway, if you have any questions, comments, or want to talk about business valuation related things, let me know. Send me an email or comment on the video, whatever you'd like to do. Have a good day.